Hi everyone from New Zealand. It's very early here. Excuse my hair, I don't know what it's doing. We're going to be talking about profit first today, which is probably boring for a lot of people. Probably everyone's going to be thinking, oh no, this is really boring. But if you can stick with me, it's actually a really good way to make sure that your finances are in order. And I will tell you the story how I did that. Um, so just tell me if you can hear me okay. I've got my headset on, hence the messy hair. And hi, Denise. So I'll just tell you a little bit about me. I started a business when I was 19 years old, and I decided to be a fashion designer, and I had no experience whatsoever, but my dad had had a business before, so I thought I can do that. And I did okay. I actually sold a few things and designed a few things and sold it to some shops, and then I actually got into debt. And my dad said, well, he didn't actually say I'm not helping you out, but I knew he wouldn't. So I had to get myself out of debt. So that was my first lesson at 19 in business. And then I started up another business after an OE, which is what we call in New Zealand overseas adventure. So we often go over to another country for a year, work and live. And then what I did was I went to London and lived there for 3 years actually, and then came back to New Zealand, and I was a nanny while I was over there. So what I did was I started finding nannies from New Zealand to work in London, and that's how my current business started. It grew to helping people from New Zealand and Australia and around the world do working holidays, volunteer group experiences, camp counselors. So, you know, the summer camps that your kids might go to in America. Well, we'll be sending Kiwis this year to work as camp counselors in America. So I've had my business since 1993 now, and initially the business had an interesting cash flow where I got commissions based, every year, and I was always able to think, out of that many commissions, I'll probably be able to spend this much money on marketing, and then the commissions came in and that was my profit. Then we started sending to countries where we had to pay a provider. So we would send someone to volunteer in Sri Lanka, and then we had to pay the volunteer project some of the money that we received from our client. And that's where things started to get a little bit messy, because what most people do is they look at their bank account and they think that's how much money they have to spend. So that's not always the case. Obviously, some of that money is tax for the tax department. Some of it might be PAYE, or what we call PAYE, which is, wages tax. Some of it might be due to a supplier already. So it's sort of tagged, but it goes into your bank account and you think you've got all this money. And so that's what I was doing. I was getting like $10,000 in my bank account and thinking, great, we're doing really well. We've got lots of money, and we would spend some. And then the bill from the project would come in and we didn't have enough money to cover it. So it really got me not searching for something, but I just stumbled across Profit First, which is this book here. It's by Michael Michalowicz, and I actually was on my way to a business retreat in California from New Zealand, so it was a long flight, and I decided to start reading the book, and it was the best thing I've ever done. What he proposes in the book is separating your bank accounts out from your operating expenses, which is your day-to-day expenses, and your cost of sales. So for me, it was making different bank accounts. So I had to make, I think, 3 new bank accounts. So all of your money goes into your income account. So you don't take any money out of that account unless you're allocating it to different categories. So that's the first rule, is that all your money goes into one account and your bills come out of a different account. So what I set up was a cost of sales account, a wages account, and the other one you set up as your owner's compensation account. And then as soon as the money comes in, you keep it in the income account until twice a month, which is the what he suggests is the 10th and the 25th. And on the 10th and the 25th, you divvy up your income. First of all, you take off your cost of sales. So in my example, say I get a sale of $10,000 and the cost of that sale that I have to pay out to the supplier in a few months will be, we'll just say for ease of maths, and this, it's actually 7 o'clock in the morning here, so I can't add very well yet. So we'll say $10,000 and the cost of sales is 5. So I would transfer $5,000 to my cost of sales account and still have $5,000 left. And then after that, that amount, which is your real revenue, not your actual revenue, because you've taken the cost of sales out of it, actually then goes into your different percentages accounts, depending on what formula you end up doing from this book. And I've actually taken a copy of this table. See if I can get it up here. It's probably backwards, but I'll also put a post in here afterwards of what this table looks like. But for me, I was in the B column, because once you take out your cost of sales, you'll find that your revenue is actually lower. So his main premise in the book means that your real revenue is your actual revenue less your cost of sales. So say you get $10,000 in and you owe $5,000 of that to someone else. So you can't make the sale without paying someone else, and that's your cost of sale. So then that amount goes into your cost of sales, and your real revenue of that $10,000 is actually just $5,000. So when you look at, most businesses are judged on their revenue, but it's not taking into account any cost of sales. So it's actually a fake number. And his whole idea is that you take the profit first. So most accountants and most bookkeepers go revenue at the top, less cost of sales, less operating expenses, and what's left at the bottom is profit. Now what he does is he suggests you turn it around and you say revenue less cost of sales equals real revenue, and then you divvy up amounts from that into your owner's compensation. So you pay yourself first, then you take a percentage for profit, and then the rest is operating expenses. So that's how you turn it around, and you can start making a profit straight away. So if you're brand new to business, I suggest you set this up right from the start. So say you make your first sale of $1,000 and you owe $200 to somebody else for that sale. You take $200 and you put it into your cost of sales account, and the $800 that you then divvy up into, start with 1% profit. So take out, say you've got, hang on, let me do some maths. Say you've got $1,000 sale, take away $200, cost of sales is $800. And if you just take 1% of that, is $8. I should have been able to work that out. That's your profit, and that goes into a profit account. Now, you can argue that if you can survive on $800, then you can survive on $792. So that's the idea of the book, is you take out 1% of profit initially. You're going to go up as you go along, that percentage will increase, but initially if cash flow is tight and you're not a brand new business, hi Anna, then this way you're just taking a little amount of profit out and you're putting it aside, and it's not going to get eaten up within the operating expenses. And it's very easy to say, even if it's $1,000 sale, and it's all real revenue, so it's no cost of sales, take 1% out, it's $100, you can still survive on $900, and that $100 is sitting in your profit account. So you do that for a whole quarter. Now I'll go over the percentages shortly and how he works them out, but what he does suggest is that you start with 1% profit and for one quarter, and you try that, and then if your operating expenses are still okay, then you go up to 2% for the next quarter, and you adjust the other percentages from there as well. Now what this does is it takes the profit out of your operating expenses before you can spend it, and it also takes out the money out of your operating expenses account into tax accounts and into other accounts that you actually need the money for, including cost of sales, so that you can't spend it. Because what we all do is we log into our bank account and we look and see how much money we've got, and we do it every day. I bet you everybody that's watching does this every day, right? You log into your bank account and you think, how much money have I got? And that's how much you think you can spend, and so you spend it. So if you actually allocate the money into different accounts, then you can't spend it, or it's not as easy to spend. It's easier to ignore if it's not in your main bank account. And then what you've got left is your operating expenses. Now, if you're not able to operate your expenses within that money that's left over, then you know you have to make some changes and you're actually not making a profit. And it's a very good indicator to say, hang on a minute, I'm actually not making any money. Why is that? Let's have a look at the costs and see what's going wrong. Because if you take your revenue and then you minus your cost of sales and what you've got left, and then you divvy that up into your owner's compensation and your profit, and then what's left is your operating expenses, and you don't have enough money to pay the bills, then that's an issue that needs looking at. And what you'll actually find is that because you've got less money in your operating expense account and it's all been divvied up into different places, you actually spend less. So you're seeing less money available to spend, so you actually, by default and by human nature, you spend less. So it's a very good way to turn around things if cash flow's been hard or you're not sure where to start. And quite often, honestly, I would get to the end of a year and my accountant would say, oh, you've made $10,000 profit. And I would like, well, where's that money? You know, because I hadn't seen it, I hadn't spent it, I hadn't spent it for myself. And now that I'm doing this, I actually have money in my profit account every quarter that I then transfer to myself as profit. And then he suggests in the book that you actually spend half of it and save half of it. So half of it is saved for a rainy day for the business, and the other half you actually take out and you do something with it, whether you want to save it in your personal life or go out for a nice dinner, or, you know, even if it's a tiny amount, just do something with it to celebrate the fact that you've actually made a profit. Or you might want to put it into a long-term savings account for something else. So even if it's only $50, then you feel like you've actually got that profit out. Because I know with businesses, hi Terry, hopefully you can get your technical issues, hopefully it's on my end, hopefully everyone can hear me. And hopefully you can watch it later, but I'll go through with you how you work out the percentages, but I really do suggest you get the book. It's called Profit First, and on the on page is it 68 is a table, and it's got across the top real revenue, and it's got between 0 and 250,000, 250,000 to 500,000, and I suggest that probably most people are in this range. You take your actual revenue and then you take away all your costs of sales. So all of the things that you have to pay out to someone else before you actually finalize the sale. So it might be, say you design websites, it might be who do you have to pay designer-wise before you deliver that website to the client. Maybe the client pays you in one amount and you have to pay some money out of that. That's your cost of sales. So once you take those off, that's your real revenue. And then that tells you which column you're going to do your percentages. So what he suggests for the column that I was in once I took away my cost of sales was 10% profit. So that's what you have to aim for. With I said start with 1% per quarter and up it by 1%. So that's what you're aiming for, is 10%. Owner's compensation, you're aiming to get to 35%. So you start with whatever you end up once you've taken off your other percentages and you've got some operating expenses. Then you're aiming to get to 35% owner's compensation and 15% tax, and tax works differently in every country, but that's also including the tax paid on any profit or owner's compensation. And then what's left over is aiming to be 40% of operating expenses. So a lot of us never know what we should be aiming for operating expenses. So that's what your percentages should look like. So you've got real revenue, 10% profit, 35% owner's compensation, 15% tax, and 40% operating expenses. So for me, I had to start with 1% profit and 1% tax because I wasn't going to be paying tax on 1% profit. And then the rest was 30, and then I went to 29% owner's compensation, and the rest was operating expenses because I was spending too much at that point. So that was really getting my operating expenses down slowly. And then in my case, I had debt as well. I had credit card debt, so my profit every quarter now goes on to my credit card until that was paid off, and then you start taking the profit out. So I hope that kind of makes sense. I know it's a little bit confusing. The book will help you make a lot more sense of it, but I can tell you that I started it in October last year. Like I say, I went to a retreat and I had all this time in an airport lounge. I set up all my accounts, my bank accounts, and I started it straight away. And at that point, I had a $20,000 credit card up to the limit, and I also had over $20,000 owed to suppliers for my volunteer experiences, and I actually had hardly any money in my bank account. So at that point I was like, I've got no money to pay my suppliers, and I was thinking, how can I divvy up money I don't even have? But I just started doing it, and I just started doing 1% profit and 29% owner's compensation. Then suddenly I had enough money to pay my staff, like for wages and things. I had money aside, and then I started paying down the credit card with the profit amount as well. And also because I was reducing my expenses, because I wasn't seeing all this money in my bank account every day, you just naturally reduce your expenses. You just think, I don't really have the money in my bank account, because you're looking at the operating expense account, not the total. So then I can tell you today in my bank account I have over $50,000, and it's all divvied up into different areas. And in my operating expense account I have $8,000. So imagine if all of that money was still in my main bank account, I would think that I had over $50,000 to spend, but I actually don't. It's all sort of divvied up. Some of it is my own owner's compensation, which is one thing that a lot of business owners don't do, is they don't take money for themselves. And this is a really good way of making sure you take enough money out of the business before you pay all the other expenses, and that's including staff. So if you can't afford staff, this is a good way to figure it out. And what he suggests in the book is, if you want to hire some staff, then you start putting the money aside for them into a different account, say for 6 months or a year. And if you've still got enough money in your operating expense account to keep going and keep paying that staff member, then you can hire them. And also you've already got some money aside to pay for their wages for a while, to make sure that the cash flow isn't too affected by it. But if you're brand new, it's perfect to set up, because you can just start right from the start and set up these percentages, set up your different bank accounts, and start putting the money into each one. So I don't want to get too technical. Hopefully that wasn't too technical, but you can ask me a question if you want to, but otherwise I suggest you get the book. It's a very good book. It is, like I say, a little bit complicated with the formulas initially, but I just set up a spreadsheet. So twice a month I allocate everything into a percentage, and I just copy the formula down on my spreadsheet to work out what the each percent is, and then I go into my bank account and I transfer it from income into all the different ones, and then what's left in the operating expense account, then I pay the bills from there. And if it's not enough money in the operating expense account, the bills either don't get paid or I have to pay it out of my own money. It's a very, very good way to make sure that you've got a healthy cash flow. So I'll hang around for a little bit for questions if anyone's got any. Otherwise I'll post this table which gives you an outline of which percentages you should be on for what revenue level you're at. Now remember, a revenue is a fake number. The revenue you normally see in most accounts are including cost of sales, which is not. That's actually somebody else's money. Hopefully that was helpful. No one's got questions. Hopefully I haven't confused everybody, but if you have questions, post them below and I shall pop in later and check them. It's only 7:20 a.m. here, so I've got lots of time during the day later to do that. I know it's late there, but if you're watching it on the replay, put the question in, I'll still see it. And I'll talk to you soon, guys.